Hi everyone, welcome to another video of what's moving the market. Today we're going to talk about how there is a possible rotation on the cards from value to growth, and that is possibly moving the markets these days. Again, just a quick disclaimer, not investment advice. Please do your own due diligence before taking investment decisions. So in our last video, we talked about how the US is reporting the highest inflation in 39 years since June 1982, and we shared our expectations that the government might move towards, the Federal Reserve might move towards a more contractionary monetary policy to control inflation, and that would of course be negative for asset prices, and that has happened, right? So over the past few days, we have seen that the market has been pricing in the same expectations that we were talking about last week, and this has led to significant declines. However, if you look at what has happened in the market in terms of which stocks have declined more than the others, so we've seen some growth stocks take significant hits, right? And that's what we're going to talk about today. First, however, we'll talk a little bit about basic differences between value and growth for those of our viewers who are not aware of the differences. Secondly, then we will talk about why for the past few years growth stocks have been outperforming value, and then now moving forward why value is expected to outperform growth now. And then if we are convinced of this, that value is expected to do well, then what type of companies within the value space shall we invest in? How should we go about doing our analysis? That is what we're going to talk about last. So first, let's understand the difference between value and growth stocks. And to do that, let us first understand a little bit about what the industry life cycle is, right? So first you have the embryonic stage, and an example over here would be space travel. So companies that are currently within the space travel industry, of course, this is a very nascent industry. None of us have actually started going to space on a commercial basis. I know astronauts are going, but that is not commercial. So this is something that is not mainstream yet. It's a very, very embryonic, or it's extremely nascent industry. And then currently prices are very high. It's almost impossible for the common man to go into space right now. But then eventually we are hoping that this comes into a phase where prices are lower, and then people can start going to space. And an example over here is electric cars. So electric cars are now becoming more mainstream. You can see them on the streets a lot more than we could. And then the next industry stage is a shakeout where the competition intensifies. So maybe we can talk about let's say mobile phones. Like initially, of course, there was Apple and just a few others, and now there is intense competition in the smartphones or mobile phones, or I think smart would be more appropriate, right? So smartphones. And then next you have is a mature phase where the industry becomes extremely low or no growth. So we can maybe talk about automobiles, and I'm talking about traditional automobiles here, of course, right? And then you get into sort of a decline and negative growth, and let's say oil and gas, oil exploration. So that, of course, is now kind of facing a negative growth, and also because of the climate issues, right? So just to give an idea, of course, these definitions are not fixed. Some people could argue that oil exploration is still mature, it's not declining. Some could say that smartphones are not just in the shakeout, they could be mature. But this is just to give you a broad understanding of the industry life cycle. And more importantly, it is for those of us who don't know about growth and value, so to kind of explain to them that value companies are possibly in the shakeout stage, in the mature stage, and even in the decline stage, right? Very, very mature companies, stable cash flows, predictable, stable cash flows, and highly profitable. However, growth companies are not that stable yet. They're expected to be, and that is the difference between growth and value. Now, why has growth outperformed value? So in order to understand that, we need to first understand how the stock market kind of values a stock, right? So the true value of a stock is calculated using the present value, where what we do is that whatever future earning potential a company has, which one method of evaluating is its ability to pay out dividends in the future, right? That is just one of the potentials. Like from an investor perspective, but even if it doesn't pay out dividend to you, it could pay, it could just keep growing in value because it use the earnings to invest in other businesses and its profitability keeps growing. But whatever its future earning potentials are, there are multiple different perspectives of doing that. The simplest is the dividend discount model, but regardless of whatever approach we take, the denominator doesn't change. And in the denominator, you have 1 plus r, where r is the interest rate, and n, where n is the number of period. So the greater n is, the lesser the present value will be of this future potential and the lesser the price will be. Because this is so far out in the future that, the current value you will put on it will be very less. So if n will be high, the present value will be low, right? So growth stocks obviously have a further out earning potential than the mature companies which are earning today. And then secondly, when you talk about interest rate, and the higher the interest rate will be, the higher this denominator will be, and then obviously the lower the present value is going to be. And since we are in a situation where the interest rate is expected to go up, right? Hence, the market is pricing in the hit on the present value. Why this has not been happening in the past, and why has growth outperformed value? Because we've had low interest rates for so many years now, and because of these low interest rates, growth has been outperforming value because this denominator has been small because of the interest rates being low, and that's why it hasn't really been discounting this future earning potential by that much. But now that interest rates are expected to go high, that's why this is taking a hit. So that is why it has been outperforming. But now why value is expected to outperform? So first of all, naturally, we need to see where we are right now in terms of the prices, right? And just to give you a very simple idea, so let's say S&P 500 is at an earnings multiple of approximately 20 times. Now, what that means is that stocks are for each $1 of earning, a stock is worth $20, right? Now, if you split that between value and growth, right? So if you talk about value versus growth companies are at an multiple of approximately 26 times, whereas value stocks are approximately at a multiple of 17 times. So this kind of average is the average is 20, but within that breakup, if you see, value is 17 times earnings, whereas growth is around 26 times earnings. So naturally, growth is very expensive and value is underpriced, right? Currently. So you'll be buying, and that is why the word value is used, because for every $1 of earning, you're only having to pay $17 for value stocks. Whereas if you will buy growth stocks, for every $1 of earning, you're paying $26 worth of $26 for every $1 of earning. And naturally, this is expensive, and the value is more value for money. Hence the word value stocks, right? So more value for money. Secondly, the earning of value stocks is expected to grow a lot as well, especially this year and the next 2 years. And naturally, if you've got this 17 to $1 and this $1 grows, right? And you buy it now. So even if this 17x ratio doesn't change and this earning grows by, let's say, 50%, I mean, you're expecting huge gains in your stocks. So this is why growth stocks are expected to not do so well compared to value stocks, because number one, value stocks are already at a cheaper valuation, so good value for money. And secondly, there is high earnings growth expected over the next few years, so naturally it will have a double benefit. Now, if we are convinced, and of course you have to do your own research, but once you do your research and you get convinced that yes, inflation is expected to stay high and contractionary monetary policy is supposed to be there, which means high interest rates, and you kind of like get convinced that you want to go and buy these value for money value stocks. So the question is which ones, right? So the way I would say is a good way to go about doing this is that first you check the analysts' estimates, right? So there are financial analysts that follow these companies and they have these target prices on them, and how they're coming up with these target prices are using the same future earning potential, and then they're discounting that earning potential, right, using the methodology that I explained to you. But again, let's not go into that detail. You can get what their target prices are, and then you don't want to listen to one specific analyst, so you can get a bunch of different analyst target prices and you can take their average, right? So it kind of smooths out the outliers, and then you can compare it to the current market price of these stocks. Now, I'll just give you some examples. For example, T-Mobile. So I checked out the analyst targets, and kind of the average target I saw was around 163 and the stock price is around 100. So there's approximately a 63% upside on T-Mobile. Again, guys, not investment advice. Please do your own due diligence. I'm just giving you some examples here that I checked out. Average targets for T-Mobile and was around 163. The current market price is between 100 101. So 63% upside is fantastic, right? Or if we talk about PayPal, so the current market price for PayPal, I believe, is around 160. And their targets are around 260. So that again is, how much is that? So I think it's on 60%, right? So again, huge upside here as well. For Nike, how much is the current price? And what's the target here? So I believe, let me just check. So I think it's around 147. And so you've got decent upside over here as well, right? So it's 142 actually right now. And let me check the targets. So around another good 30% upside over here. So I mean, just take a very, very data oriented approach. And if you remember in my last video, I had told you that make sure that the companies that you are investing in, they have such good brands or such good proprietary technology that their customers are loyal. And why that is important is because, in the inflationary environment that we're seeing these days, prices are expected to go up. Even the raw material prices are expected to go up, right? And if whatever their cost of doing business is, whatever their inputs are, if those prices go up, then these companies should have the ability to kind of pass on the price increases to their customers without losing business, so that their revenue increases in terms of price per unit, and the number of units also doesn't fall. So overall revenue increases and then overall profit increases. And the second thing I talked about in my last video, and I would repeat here, is that make sure that you look into the debt which these companies have got. Is it on like a floating rate or is it on a fixed rate? In my last video, I gave the example of Amazon raising debt at a phenomenally, or rather the cheapest bond issue there was in US history. So do look into that, guys, and make sure you get multiple analyst estimates and then see the average targets and then compare to the market price to calculate the potential upside. Again, happy investing, wish you all the best, and hope to see you in the next video, inshallah. Thank you very much.